Hello folks, it is Sunday, June 18. It's about noon o'clock on the east coast of the United States. In this video, I'm going to talk about interest rates and what I expect going forward. And this video is motivated by a question I got on my last video. Had a viewer ask, do you still see interest rates rising after the Fed meeting? Now, short answer is yes. But I didn't want to just give my knee-jerk response. You know, my bias is for higher interest rates for years to come. But I wanted to provide some background to that answer. And so that's what I'm going to do in this video. So let's start with money creation. Now, if we were a banana republic or any country that was a banana republic, we'd just go down into the basement, we'd fire up our printing press, we'd run a bunch of fiat currency off the printing press, and we'd put it into circulation in the economy. But that's the definition of a banana republic, and, you know, we're sophisticated, intelligent human beings. We can do better than that. And so to avoid looking like a banana republic, we have to obfuscate the fact that we're just printing money and putting it into circulation. I mean, that's what fiat currency is, but we don't want to, we want to dress it up a little bit. And so as a smart banana republic, we introduce a couple of things. Well, two specifically. Basically, it's debt instruments and buyers of those debt instruments. And so instead of starting by printing fiat currency, we're going to start by printing debt instruments. And of course, here in the United States, we call them treasuries, but you know, we've got three flavors: bills, notes, and bonds, depending on the duration of those instruments. Buyers can be individuals, countries, institutions, you know, pension funds, hedge funds, etc. All that matters is that they buy our debt instruments. So anyway, we run the printing press, we create debt instruments, buyers buy those debt instruments, and now we go back down into the basement with our other printing press, we print up our fiat currency, and we tell the world that that fiat currency is backed by our debt instruments. So we're still playing the same game, but we've obfuscated the fact that really all we're doing is printing fiat currency and throwing it out there into the economy. So anyway, that's what we're going to do as a smart banana republic. And this next slide, let me keep going this way. If we were just to let the Federal Reserve act as the buyer of last resort, the only buyer of our debt instruments, well, that quickly becomes obvious because, you know, people can see what the balance of the Federal Reserve, they make part of their books public, and it would quickly become obvious that, you know, we're creating these debt instruments, but all that's happening is that the Federal Reserve is buying them. So we can't have the Federal Reserve buy all of our debt instruments, or we'd be back looking like a banana republic again. So we need buyers other than the Federal Reserve to step into the market who will buy our debt. So yeah, we need buyers who aren't the Fed. And not only do we need buyers that aren't the Fed, we need those buyers to increase the amount of debt they're buying every year. That's part of one of the truisms, one of the parts of a fiat currency system, debt-based system, is that it is exponential. Every year, the debt grows bigger, the spending grows bigger, the deficit spending, in the case of the United States, grows bigger, and we can see that in this chart, you know. Up until, you know, the 70s, late 60s, early 70s, we were running, you know, somewhat of a balanced budget. And then we got into deficit spending. This little blip here, that was machinations, that we were still deficit spending, but they cooked the books so it looked like we weren't. After 2003, you know, the deficit spending has done nothing but increase. At the current point, this was 2020, 2021, we were doing $3 trillion a year in deficit spending. They've dressed it up a little bit. We're back, currently it's about $1.5 trillion of deficit spending. That's what the charts show. I think in reality, deficit spending has increased to the rate where currently we're at $3 or $4 trillion a year in deficit spending, and will be forever. Until the wheels come off, we will be, our country, the United States, will be deficit spending at the rate of $3-4 trillion a year at least. Let's continue. So deficit spending is increasing, so we need buyers to increase their offtake of debt instruments. That's what I just said. Are they doing that? Are the buyers increasing their offtake of debt instruments? And the answer is no. And something changed back in 2014. We can see that here in this chart. So this is information coming straight from, our government. If you don't believe me, believe the government. I hope you'd believe me before you'd believe the government, but you don't know me. So anyway, you can believe it because it comes straight from the government. And what we're seeing in these charts is back in 2014, something changed. Foreigners stopped buying they didn't stop buying our debt, but they stopped buying as much of our debt. We needed them to continue increasing the amount of debt they were buying. Instead, they started tapering off. And we can see, in this chart, they're showing total treasuries. There's long-term, there's short-term, FRNs, that's currency, that's folding money. TIPS, those are inflation-adjusted treasuries. And so it doesn't matter what we look at, foreign buying of treasury debt started to taper off started in 2014, tapering off. We can see that again in this chart, a little bit clearer here perhaps. 2014, foreigners stopped. I keep using the word stop. They didn't stop. They started to taper their buying of U.S. Treasury debt. And that's what we see there, is it's a tapering. They aren't buying as much debt as we are creating. And that's why this chart starts to slope downwards. And so it's uh-oh moment. What do we do now? We got a problem. We don't want to look like a banana republic. We need buyers. We need people to buy our debt, or we're going to start looking like a banana republic again. Again. So what do we do? Well, one of the things we can do is obfuscate the situation by creating buyers. And one of the ways we can do that, there are multiple ways, but one of the ways we can do that is through currency swaps. And so let's talk about currency swaps. So let's go back down into the printing press here in America and print up $500 billion worth of Benjamins. We're going to roll $500 billion worth of $100 bills off the printing press. Well, we're going to call up our buddies at the European Central Bank and we're going to say, hey, you need to print up $500 billion worth of euros. Go down in your basement, fire up your printing presses, $500 billion worth of euros, and then we're going to swap them. So what do the books look like at the end of this transaction? The United States started with $500 billion worth of U.S. money. The European Central Bank started with $500 billion worth of euros, and then we swapped them. So at the end of this transaction, it's a wash. We started with 500 billion, we ended with 500 billion, nothing has changed. Well, now let's do the second part of this transaction. Back down into the basement again, fire up the printing presses, only this time we're going to print debt instruments. And so U.S. Treasury is going to print up $500 billion worth of Treasury bonds. ECB is going to print up $500 billion worth of Euro bonds. And now the U.S. Treasury, or the Fed, is going to take the $500 billion worth of euros, and they're going to go buy those $500 billion worth of Euro bonds from the ECB. And the ECB is going to take the $500 billion worth of Benjamins and go buy the $500 billion worth of Treasury bonds. And again, at the end of this transaction, it's all a wash. We started with 500 billion. We ended up with 500 billion. On the balance sheet doesn't change. Nothing has changed on the balance sheet. Only if we look at it from another perspective, we see that $1 trillion worth of new fiat currency has been created, and $1 trillion worth of debt instruments have been created. So it's not really a wash, but if you're only looking at the balance sheets, basically this currency swap transaction is a wash. And key point for this video, we have created a buyer for our debt instruments. The ECB just bought $500 billion worth of U.S. Treasury debt, but they used the money that we printed and gave to them. And so anyway, the debt-based economy, it's just so, God, I'm not thinking of the right word. It's not transparent. It's wrong. It's dishonest. I guess maybe that's the best word, it's dishonest, but they obfuscate it to the point where the common guy in the streets doesn't understand what's going on, and so he doesn't realize the extent to which the debt-based system is dishonest. It's as dishonest as the day is long, at least. When I first became aware of something fishy going on, it was back around 2014. Started seeing articles. People were questioning Belgium. Belgium stepped into the bond buying market in a big way. And people were asking, it's like, well, Belgium, it's not really a big country. I think their GDP is, at that point, their GDP was about $400 billion a year. And that's about how much treasury debt they were buying. It was like, does that make any sense to you? You got $400 billion GDP, the size of your economy, and somehow you're buying that much U.S. Treasury debt every year. To me, that doesn't make any sense. There's something fishy going on there. In this table, this, again, .gov, that's your trusty government providing you with data. In Table B here, we see this is foreign holdings of U.S. securities by country. And so that's key. Notice we're talking about countries, sovereign individual countries. We're not talking about pension funds, billionaires, investment. We're talking about countries buying and holding U.S. Treasury debt. And so look at this. Number 3, Cayman Islands. Okay, well, that's interesting. Cayman Islands is a tiny country, isn't it? Well, look at here. Cayman Islands GDP, $6 billion a year. $6 billion a year. Now, how in the heck is the Cayman Islands the number 3 holder of U.S. Treasury debt when their annual GDP is only $6 billion? Luxembourg, number 4. Let's look at this. Luxembourg. If we could spell Berg, there's an R and a G. Oops, and they aren't an island. I don't think, not last time I looked. 85 billion. So again, Luxembourg, GDP, 85 billion. How are they number 4 holder of U.S. Treasury debt? It just doesn't make any sense. Here's Belgium way down here. Maybe that makes more sense. And they've actually got, their GDP is 400 or 500. Let's look here. Belgium, a little bit easier to spell. There's no R in there. 600 billion of debt. That's a little bit more reasonable that they're down there at number 9. Okay, $600 billion GDP. They're a big buyer of U.S. Treasury debt. But they aren't Cayman Islands at number 3. So let's keep going. So now we're back to the original question. Do you see interest rates still going up after the Fed meeting? My answer is yes. And for two reasons that I'm going to talk about here. Number one is the previous game, the obfuscation of trying not to look like a banana republic, that game's over. I mean, clearly it's not over. We're in the end phase, in my opinion. When you get to the point where the Cayman Islands is the number 3 holder of your treasury, of your debt instruments, the game is over, folks. And then, so if this game is over, well, what do? Now you got to play a real game. And legitimate buyers of debt instruments, they're only interested in two things. Number one is safety. They want to know that their money is safe. And of course, nominally, U.S. Treasury debt is supposed to be the safest instruments in the world, backed by the U.S. taxpayer and all that good stuff. So anyway, U.S. Treasury debt is supposedly safe. Until recently, it didn't offer any yield. It was at 0%. If I got money in the bank, I'm not going to buy your debt instruments at 0%. Why would I do that? That's just stupid. And so they had to start raising interest rates. And again, this is me stating my opinion, had to start raising interest rates in an attempt to attract legitimate buyers of debt. And that's what I'm saying here. Interest rates have to increase in order to attract legitimate buyers of debt. And I believe that's where we are at currently. If we look at what happened so far in June, maybe this may have gone back into May. So the U.S. Fed just paused. So they didn't raise another quarter point. They certainly didn't pivot. ECB hiked a quarter of a point, and Canada hiked a quarter of a point. The IMF came out and said, they said two things, actually. They said that the U.S. Fed needs to hike another quarter point. The IMF said that the Fed needs to be at 5.5%. And then the second thing the IMF said is that they expect that interest rates will remain in the 5.25% to 5.5% range until late in 2024. So I've said this before, but I'll say it again. If you're expecting a pivot as part of your investing strategy, you might want to come up with plan B. There's not going to be a pivot. They aren't going to pivot. They have to keep raising interest rates in order to attract legitimate buyers of debt instruments. And so that's my summary of the answer. Do I expect higher interest rates? My answer is yes, and I've explained a little bit of why I think that the answer should be yes. Let's look at a couple of charts before we wrap up here. I like this chart. This is the yield on the 10-year Treasury note. In the pink lines here, this downward sloping channel, this is a 40-year downtrend. We started way up here, in early 80s, so that was 82, late 81, going into 82. We're up here at almost 16%. Mortgage on a single-family house was pushing 20%. Imagine buying a house with a 20% mortgage. Inconceivable to us at this point. We may get there again, but hard to imagine at this point. Mortgage rates currently about 7%. But so anyway, they pushed rates down. We got into this channel, and for 40 years, we had downward trending interest rates. They got down almost to zero. Here in this chart, we can see it's about 0.5%. In the European debt markets, they actually got into negative interest rates, which, that clearly doesn't make sense. Anybody with 3 brain cells to rub together knows that negative interest rates don't make any sense at all. But so anyway, 40-year downtrend in interest rates, and then something changed. Actually changed back here. So this was February of 2020. Remember the big scary plunge? That was in March of 2020. Something happened in our economy. Something dramatic happened in our economy back in March of 2020. big scary plunge in the equity markets and the precious metals markets as well. And then interest rates started rising. December of 2021, we got the Evergrande default. That's the Chinese real estate developer. They defaulted on $300 billion worth of debt. And that debt was not isolated to China. U.S. investors were affected by that default. They were holding some of the Evergrande debt. European investors were holding some of that debt. And so anyway, this Evergrande default rippled out through the world. In my opinion, that was the start of the global collapse in debt. We went for a few more months, and then we got the breakout from this 40-year downtrend. And that was, what is that? That's January of 2022, March of 2022. Anyway, early of 2022, interest rates broke out of that 40-year downtrend and clearly started heading higher. This wasn't a little blip. We can see along here, okay, there's an overthrow to the upside back into the channel. Overthrow to the upside back into the channel. This isn't an overthrow, folks. This is a change in trend, change in behavior. Interest rates are headed higher. The 40-year downtrend is over. And so if we're looking, history doesn't have to repeat, but if we go back and look at, okay, when is the last time that we got a sustained uptrend in interest rates? Well, we have to go all the way back here to 1963, and we can see it here in this chart. That's 18 years of rising interest rates. And so when I say to you, I expect higher interest rates for years to come, I'm basing it on this in part. I'm basing it on history, 18 years of rising interest rates. And so to think that we're just going to get, we're going to pop up to 5% and then we're going to go back to zero. No, that's not my expectation at all. I expect multiple years of increasing interest rates. And so again, if you're sitting here and your investment strategy is counting on a pivot, a permanent pause, we're going to hold at 5% forever, that's not my expectation. So, we all have to handle our money as we feel appropriate for ourselves. But if you're looking for my opinion, multiple years of increasing interest rates. In this chart, I just threw, these are my standard technical analysis tools. I like MACD. We can see based on where do we become overbought based on MACD. At what level would interest rates reach an overbought level? In this chart, we can see, we go back to the early 82 when interest rates were up here at 16%. There's where MACD peaked at that point. We're nowhere close to that. And so based on MACD, interest rates have much further to rise before they reach that same level of overboughtness. Doesn't mean they have to reach that level. MACD can do whatever it wants to do. It's not a bounded indicator. Energy, I use slow stochastics as my measure, one of my measures of energy in the financial markets. Clearly it's elevated. So based on stochastics, the interest rates have energy to move higher. So we certainly see higher interest rates based on stochastics. Andrew's pitchforks, we can see that currently we've bumped into resistance at the upper median line of this Andrew's pitchfork, and we're pulling back from that level. We've got this horizontal support resistance level. We call it a zone. I could have drawn it as a rectangle. But anyway, we ran into resistance, we're pulling back, and it looks like we're testing this horizontal level for support, and now we're bouncing higher. And you see that, there's the test of support, and now we're moving back to the upside. And so based on this chart, it looks to me like we've had our breakout, we've pushed up through the prior high, we ran into resistance, we've gotten a pullback where we tested support, and now we're back headed higher again. And so again, based on technical analysis of this one chart, I could make a case, and I am making the case, for higher interest rates for a sustained period. And again, we're looking at a monthly chart. So, this is a long-term trends. Oh, and I forgot another thing, MACD, we're in bull mode. And so that's when both indicator lines of the MACD indicator are above the zero level. That's bull mode, which suggests that the primary trend of the instrument is upwards. And so that's another factor suggesting that the ongoing trend, the current trend, primary trend in interest rates is towards higher interest rates. One more chart and then we'll be done. This is one of my favorite charts. It condenses so much into a single chart. So when this chart is moving vertically, bad things are happening in the economy. And so we can see, here's the financial crisis, 2007, 2008. Here's the big scary plunge in 2020. And this, in my opinion, is the global debt collapse. What we're seeing in this vertical move, this is the collapse of the global debt system, the fiat currency / debt-based system. That's what we're seeing here. Excuse me. Now, I'm wrapping up here. I don't want to go into it, but just as another factor to support the idea of higher interest rates for longer, as I've pointed out, we need to attract buyers. We need people, individuals, entity. We need some kind of entity to buy our debt instruments, or we look like a banana republic who's just printing fiat currency and throwing it out into the economy. Well, there's some significant changes going on in the financial world, and let me just throw out some acronyms. BRICS, SCO, BRI. And so BRICS, I'm assuming everybody knows Brazil, Russia, India, China. There's actually a plus by it now because we've got South Africa. And in late August of this year, we've got the next BRICS summit. I expect that 19 countries will be added to BRICS Plus. And so at that point, we'll be up to 25 or 26 countries in the BRICS organization and some major players. One of the next countries to join is Saudi Arabia, which is going to blow out the whole petrodollar system. I'm not going to go into that now. So anyway, BRICS, that's one of the acronyms. SCO, that's the Shanghai Cooperation Organization, SCO. Again, another group of countries, mostly Asian countries, that are creating another financial system. And then BRI, of course, is China's Belt and Road Initiative. So those three acronyms, that collection of countries represents 80% approximately of planet Earth's population. And of course, when you're talking about 80% of the people on the planet, you're talking about a significant part of the economy, the financial system. My expectation and my hope is that at the BRICS summit in August, they will announce not only that these countries are joining BRICS, they will also announce their new gold-backed currency. And so that transitions or segues into my standard pitch for gold. You need to have some, folks. If you haven't secured some physical gold, go down to your coin shop tomorrow morning and buy some physical silver and gold. Put it into your hot little hands, bury it in the garden, tuck it into your safe, put it wherever you're going to put it. But put your hands on some physical silver and gold if you want to protect your retirement savings. your tax advantaged money in your if you've got an eligible 401k, your IRA, your TSP, your 457, your 403b, your annuity, your pension, etc. Just about any of your retirement accounts can be rolled into a Gold IRA. And in the description below this video, you'll find a link to Augusta Precious Metals. That's my first choice. If you ask me what's the best Gold IRA company out there, I'd tell you it's Augusta Precious Metals. And so if you want to investigate the possibility of putting some of your retirement savings into a Gold IRA, I suggest that you reach out to Augusta, get their investor kit. If you're interested, they've got representatives that can answer all of your questions. So hopefully I've answered the question. The person that asked, do I expect interest rates to increase? It's an emphatic yes. And not only is it yes, I expect that increase to occur for years to come. I wouldn't even make a guess at this point as to where interest rates will peak, but it's much higher than where we're at currently. And I'm going to wrap it up there, folks. Have a fantastic day, and I will talk to you soon.